Welcome to the deep dive. Today we're looking at a real financial head-scratcher. The petrochemical giant Lyondell Basell, ticker LYB. You see this screaming 12.5% dividend yield, which is incredible. But then you look closer and you see these big headline net losses.
Right.
So the mission for us is, pretty simple. Is this stock a once-in-a-generation income opportunity, or is it just a catastrophic value trap waiting to spring?
And the entire investment thesis, it really all hangs on understanding one single thing.
Okay, what's that?
It's the divergence between what accountants record as earnings and what the company actually has in the bank as distributable cash flow. You have to ignore the paper losses and just follow the money.
Wait, you're telling me we should just ignore a Q3 2025 net loss of, $890 million?
Yeah.
That's a massive, frankly, terrifying number for a company paying a double-digit yield.
Well, not ignore it, but we have to understand what it is. Despite that huge statutory loss, the company actually generated $983 million in operating cash flow.
That's a 135% cash conversion rate.
Exactly.
That sounds insane. How is that even possible?
The key is realizing that the $890 million loss wasn't a cash problem. It was, basically an accounting footnote. The loss was driven almost entirely by large, non-cash asset impairments. Think of it like writing down the value of an old property on your books. It looks bad on paper, but your bank account is untouched. Lyondell Basell is still a cash-generating machine.
Okay, so if the cash is fine, why is this stock priced so poorly? We know the industry is facing this huge cyclical headwind. They're calling it the petrochemical winter, right?
That's exactly right. The industry is navigating some significant global overcapacity, and most of that is being driven by this aggressive expansion in China. It is brutal out there.
But LYB has a defense.
It has a structural shield protecting its cash flow. It's centered in their O&P Americas segment, and it's called the shale gas advantage.
That's their big competitive edge.
It's their lifeline, really. The O&T Americas business runs on cheaper ethane feedstock, which comes from all that plentiful U.S. natural gas.
Right.
This gives them a structural cost advantage that their competitors in Europe and Asia, who rely on expensive oil-derived naphtha, they just can't touch it. That resilience is what safeguards their margins, even now.
So they can survive the downturn thanks to cheap gas.
Yeah.
But, surviving isn't the same as growing. What is management actually doing to improve the quality of future earnings?
They're focused on two major game changers to boost free cash flow. First, they are getting out of the volatile refining business completely. They closed the Houston refinery earlier this year.
Okay.
That move alone eliminates a huge source of volatility, and maybe more importantly, it permanently avoids hundreds of millions in future maintenance capital.
So getting rid of a problem child frees up cash for everything else.
Precisely. And second, they're tightening their belts like crazy. They've launched this thing called the Value Enhancement Program, or VEP.
Right, the VEP.
And that's targeting about $1.1 billion in structural cost cuts by the end of 2026. Every dollar they save there flows directly to the bottom line, no matter what commodity prices are doing.
And what about that big long-term growth engine we've been hearing about, the plastics recycling?
Yeah, that's their circular and low-carbon solutions business. It uses their own proprietary MoreTech technology. Management projects this segment will generate an extra $1 billion in EBITDA by 2030. It's their path to more premium earnings down the road.
So let's circle all the way back to the original question. Can they sustain a 12.5% yield? Is that dividend safe?
The short answer is yes. The annual dividend costs them about $1.79 billion. Based on estimates, their 2026 free cash flow should be around $2.6 billion.
So the payout ratio is, just under 70%?
About 69%. It's tight, but it's manageable. And crucially, they have $6.5 billion in total liquidity to smooth out any short-term bumps in the road.
Which means if that cyclical recovery happens and they hit these cost cuts, there could be, 75 to 100% upside in the stock. It's definitely a high-risk, high-reward play.
No doubt.
We've answered whether the dividend is safe. I think the bigger question is what this extreme pricing is really telling us.
Well, think about this. The stock is currently yielding double its competitor Dow and quadruple Westlake. So a final thought for you to consider is this. What does that level of extreme pessimism, reflected in a stock yielding so much more than its peers, reveal about the market's current outlook on the entire global industrial economy?